Hello, and welcome once again to very interesting topics in insurance. And this is Citired Mentoring Solutions presenting to you marine FAQs. And if you have been enjoying our videos, please click on the subscribe button and also the bell icon so that you'll be notified. So, coming to insurance policies. So when we are transporting cargo, you must have heard about the single shipment policy or the annual policy, the time policies. Okay, so these are one is for a single voyage and one is for a certain length of time, which are also sometimes called as annual policies. Now, apart from these two, there are many other policies. There is a fleet policy, there is a port risk policy, there is a value policy, and maybe another 10 policies which can get you covered for most of the time. But here in Australia, there is these two other policies which are more interesting and a little bit more helpful than your single shipment and time policies. So the first one I'm going to talk about is the open policies. Now this is very similar to your annual policies and sets out the same type of information which you'll find on any policy document. It will say who is insured, what is insured, and the limits. Of course, the exclusions as well. But these types of policies are more commonly used by commodity traders, those who are trading in bulk and quite regular. So this is a good policy for them. And now I have marked some words which are not so much as insurance words as they are just English words like conjunctions and joining words, which you have to be careful of when you read your insurance documents, because that is where the catch can be. If you miss out these words, you might have not understood your insurance policy correctly. So coming back to this open policies, it says they do, however, differ in a number of fundamental ways. So in which ways are these policies differing from annual policies? Now a policy, an open policy, will have a commencement date but will only lapse when either the insured or the insurance company gives a written notice of cancellation. So this is important to note. So you know your policy has started and it is open-ended till either the insurance company or yourself, the insured, gives a written notice. This notice period is usually 30 or 60 days, 1 month or 2 months, depending on what has been agreed. So this will be already mentioned in the document itself when you first make the policy, that what is the notice period to be given for cancellation. Now, sometimes under a purchase or sale contract, we are required to provide insurance. For example, you have your CIF in Kotam, okay, CIP. So these out here, the insurance is required, and it's already mentioned in the Incoterm. So where there's an obligation to declare each and every shipment, and the insurance company has an obligation to accept these shipments. Now, the next point is very interesting. So this it's already in the part of your contract and the insurance company sees it. So there's a mutual obligations. One is that the insured person will declare the shipments, and the other, from the insurance company, they have an obligation to accept these shipments. Obviously, if either party is not happy with any of this understanding, you can go back to that cancellation a notice agreement whether to cancel or not. You can go to a different insurer. The insurance company can also do that if they are not happy to accept these shipments. An open policy will usually contain an errors and omissions clause that automatically covers the insured in case you fail to make a declaration or make an error in your declaration. So you are obliged to declare, but sometimes you might forget or miss out or make an error in declaration. So that is when this errors and omissions clause, it protects you. You can always show this clause. So make sure that that clause is there. Now, rather than paying the premium at the beginning of the policy year based on estimated values, in an open policy, premiums are paid on a monthly basis, and it requires the completion of a monthly schedule of the shipments made during the period. That is understood. So because this is for people who are regular traders, commodities and bulk, so you know that there can be a monthly schedule if there's an agreement, a sale contract, a purchase contract, where the supply will be for a long term. So that premiums you can pay on a monthly basis. But the schedule is also submitted to insurers. They calculate the premium and issue the invoice accordingly. So it happens on a monthly basis. Sometimes you don't have to remember this because the insurance company, they already invoice you. It's their bread and butter. So they will remind you every month or and in that period of time duration to pay your premiums. Now some shipments obviously do not require an insurance certificate to be issued. That shipment is recorded on monthly declaration schedule, and there is an example which I cannot be showing here, but yes. Now, apart from these open policies, there's something called as your coverall policies, such as stock throughput insurance. Now, some insurance brokers, what they will do is they will advise you and they will provide with you in conjunction with your insurance companies. What they'll do is you have the option of getting one cover all policies. So just for you to remember this, just think of like an overall, something that covers you from head to foot, or rather the neck to the foot. So this is one policy or one piece of cloth which covers you throughout. Solutions for international and domestic traders and manufacturers. Now this word manufacturers is also important. So because it covers your cargo, whether static or in transit. So you see the word stock and throughput. So whether static or in transit. Now describe the benefits of this product. Okay. Cover attaches from the time the insured assumes an interest or responsibility and continues uninterrupted. So like I told you, the overall that you wear, you see it's all one piece of material, like some people also call it a boiler suit, which will it continues uninterrupted from your shirt to your trousers. There's no division. until the interest or responsibility ceases. Now, there are options, single policy and simplified premium basis. This reduces your administration requirements, and there are no time consuming declarations to submit. Remember, we spoke in the previous one where you have to declare your shipments. Out here, it just covers you for all. Now, the gaps in cover are significantly reduced or eliminated. Okay. Now, there is an acronym of GAP, Guaranteed Asset Protection. And apart from that, so there's always, when you look at the Incoterms, we have to be very careful to notice where the risk transfers from the buyer to the seller. And if insurance is in picture, I'll give a small example. For the Incoterm FAS and FOB, free alongside ship and free on board. So alongside ship is not on board. So at this point, there is a transfer of risk. Similarly to that, where your goods are covered, insured for, there will be some place, some point where the risk transfer is a bit obscure and not clear cut. Those are the gaps which are covered by these coverall policies. So it's one policy which covers you throughout the transit process. Even when it is lying in the warehouse, it is static, and nobody really is taking responsibility for it at that moment because they're still unsure where to send that cargo. Sometimes things like that can happen. Now, the premium is very competitive compared to your traditional method of insuring, and where the transit and inventory exposures, what I just spoke about a few seconds ago. So when you're putting it in storage, inventory, there is some exposure to risk. And when it is in transit, and there is a different exposure to risk. So this used to be covered for separately, whereas out here, there's one insurance to cover the whole thing. But it can be tailor-made and customized to the particular needs of each client. A client might say, yeah, they can go through the finer points and details and give their opinion based on that. This is interesting. Each stock can be valued on a selling price basis. Now, the manufacturer, they make the products, and there is a cost, something it costs them, which is their cost price. But when it is insured for coverage, because it is already in transit, the values already, the end buyers will be buying it on a selling price, on a sale price basis. And that is what the stock will be valued at. I hope you understood this properly. So the value of the stock is not what it cost the manufacturer to make it, but the value of the stock is what it is going to cost the buyer to buy it. And in doing that, the profit element is also included in the coverage. And then, there's some other coverage called the business interruption coverage, which is a different topic to go into, or something to maintain your business continuity plan. So you would not need to cover for that. Right. And then third-party locations, it can include coverage for that. There's another interesting thing: the deductibles get lower options. For like the compulsory thing that goes out of the pocket of the insured during insurance claims. So those deductibles that can be lowered down, and it applies to all types of stock cargo, like we mentioned in the previous open policy, mainly for commodities and bulk trading. Out here, this one says it applies to all types of cargo. And yes, so where there's the locations which are more prone to floods, windstorms, and even especially earthquakes, because earthquakes, they don't just cause havoc on land, but if it's somewhere in the sea, they can also cause tsunamis, and we're all aware of that. So, and because this it's one policy to cover everything, so even those locations can be included. If you saw my previous video on premium rates, you would have noticed that the premium rates depends on the locations of transport. So this one, it removes all gaps as we discussed earlier, and has some obvious benefits in risk and administrative management burdens. Well, that was very interesting, and it was nice being able to share this with you. So I do hope you enjoyed this video, and we look forward for the next time. Thank you.